Hey there, I'm Anders Buckley, and today we're investigating a number that quietly influences millions of financial decisions every year. Most people know it exists. Few fully understand it. Yet it can affect whether you qualify for a loan, the interest rate you receive, the credit card offers available to you, and sometimes even housing opportunities. Imagine two college graduates. Both have jobs. Both earn similar incomes. Both apply for a car loan. One receives an excellent interest rate. The other pays significantly more. The difference could cost thousands of dollars over time. What caused it? In many cases, the answer is a credit score. A credit score is a three-digit number designed to estimate how likely someone is to repay borrowed money on time. To lenders, it serves as a measure of risk. Higher scores generally indicate lower risk. Lower scores suggest greater uncertainty. Because lenders cannot predict the future, they often look to the past. They examine borrowing behavior, payment habits, debt levels, and other financial information. Those details help create the score that follows a borrower through much of their financial life. But where does this number come from? Who calculates it? What information is being used? And what actions can improve or damage it? Over the next several minutes, we'll answer those questions. We'll investigate how credit scores are built, why they matter, and how students can begin building strong credit habits today. Every loan creates a simple question: will the money be paid back? Banks, credit card companies, mortgage lenders, auto lenders all face that same question. And because nobody can predict the future with certainty, lenders rely on probabilities. They look for evidence that a borrower has managed credit responsibly in the past. One of the most common tools used for that purpose is the FICO score. The FICO score is the most widely used credit scoring model in the United States. It generally ranges from 300 to 850. Higher scores indicate lower credit risk. Lower scores indicate higher credit risk. To a lender, that score helps estimate the likelihood that future payments will arrive on time. And that estimate affects real financial outcomes. Consider two borrowers applying for the same auto loan. Both earn similar incomes. Both want the same vehicle. Yet one receives a much lower interest rate. Why? Because lenders believe that borrower represents less risk. Over the life of the loan, the lower rate borrower may save thousands of dollars in interest costs. The vehicle is the same, the loan amount is the same, but the cost of borrowing is dramatically different. Credit scores can influence more than loans. Landlords may review credit information before approving rental applications. Insurance companies may consider credit-related information when determining premiums. Some employers may review credit reports as part of the hiring process where permitted by law. For better or worse, a credit score often becomes part of a person's financial reputation. The question is how that reputation is created, what information is being examined, and what financial behaviors matter most. A credit score may seem like a mysterious number, but it is not created randomly. The FICO score is built using information from 5 major categories. Each category contributes a different amount to the final score. The largest factor is payment history. This category accounts for 35% of the score. Lenders want to know whether bills have been paid on time, because past payment behavior often provides clues about future behavior. The second factor is amounts owed. This accounts for 30% of the score. It measures how much debt a person carries relative to available credit. Next comes length of credit history. This category represents 15% of the score. In general, longer credit histories provide more information for lenders to evaluate. The fourth category is new credit. This contributes 10% of the score. Opening several new accounts in a short period can increase perceived risk. The final category is credit mix. This also represents 10% of the score. It considers the variety of credit accounts a person manages, such as credit cards, auto loans, student loans, or mortgages. Notice something important. Not all categories carry the same weight. Payment history alone is worth more than credit mix and new credit combined. That means certain financial behaviors have a much larger impact than others. A single missed payment may cause significant damage, while improving a smaller category may have only a modest effect. Understanding these 5 categories is the first step toward understanding how credit scores are built, because every score ultimately reflects patterns of financial behavior over time. Of all the factors used to calculate a FICO score, none carries more weight than payment history. In fact, payment history alone accounts for 35% of the score, more than any other category. The reason is simple. Lenders want evidence that borrowers keep their promises. When a payment is due, do they pay it? And do they pay it on time? Every on-time payment helps establish a record of reliability. Every late payment raises concerns. Even a single missed payment can have consequences. The impact depends on several factors. How late was the payment? How recently did it occur? And how strong was the credit profile beforehand? A borrower with an excellent credit history may see a significant drop after just one serious delinquency. Repeated late payments can cause even greater damage. What makes payment history especially important is that negative information can remain on a credit report for years. That means a short-term mistake can create long-term consequences. The good news is that positive habits also accumulate over time. Each month that bills are paid on schedule, another positive record is added, month after month, year after year. Many people believe building credit requires complicated strategies, but often the most powerful action is also the simplest. Pay every bill on time, every month, without exception. Because when lenders evaluate a borrower, nothing speaks louder than a proven history of meeting financial obligations. And that history begins one payment at a time. Many people assume that carrying a large balance automatically improves their credit score. In reality, the opposite is often true. The second largest factor in a FICO score is amounts owed. This category accounts for 30% of the score. One of the most important measurements within this category is credit utilization. Credit utilization compares how much credit you are using to how much credit is available. For example, suppose a credit card has a limit of $5,000. If the balance is $1,000, the utilization rate is 20%. If the balance rises to $4,500, the utilization rate jumps to 90%. To lenders, high utilization can be a warning sign. It may suggest that a borrower is becoming overly dependent on credit. Lower utilization generally signals greater financial flexibility. Many financial professionals recommend keeping utilization below 30%. For the strongest scores, many borrowers aim for less than 10%. An important detail is that utilization is based on balances reported to the credit bureaus. Even borrowers who pay their cards in full each month can sometimes report high utilization if balances are high when statements are issued. This is one reason why timing can matter. The goal is not to avoid using credit. The goal is to use it responsibly. Credit cards can be useful financial tools, but consistently approaching the credit limit can damage a score, even when payments are made on time. Responsible borrowing is not just about paying bills. It is also about managing how much debt is carried at any given time. Not every factor in a credit score is about making payments or managing balances. Some factors focus on experience. One of those factors is the length of credit history. This category accounts for 15% of a FICO score. Lenders generally prefer to see a longer track record of responsible borrowing. The age of your oldest account matters. The age of your newest account matters. And the average age of all your accounts matters as well. This is one reason why closing old credit cards is not always a good idea. An older account may continue contributing valuable history to your credit profile. Another factor is new credit. This category represents 10% of the score. Opening several new accounts in a short period can create concern for lenders. Each application may generate a hard inquiry. Too many inquiries within a short time can temporarily lower a score. That does not mean people should never apply for credit. It simply means new accounts should be opened thoughtfully rather than impulsively. The final category is credit mix. This also accounts for 10% of the score. Credit mix refers to the variety of credit accounts a person manages. Examples include credit cards, student loans, auto loans, and mortgages. Managing different types of credit responsibly can demonstrate financial maturity. However, it is important not to open unnecessary accounts simply to improve credit mix. The strongest credit profiles are usually built through responsible financial decisions, not through complicated strategies. Patience, consistency, and responsible borrowing remain the most effective tools for building strong credit. A credit score does not appear out of thin air. It is built from information contained in a credit report. Think of a credit report as a financial record book. It contains detailed information about a person's borrowing history and repayment behavior. Lenders use this information to evaluate risk. Credit scoring models use it to calculate scores. A typical credit report contains several sections. One section includes personal identifying information, such as your name, current and previous addresses, and employment information. Another section contains details about credit accounts, credit cards, student loans, auto loans, mortgages, account balances, credit limits, and payment history. Credit reports also contain credit inquiries. These show who has recently requested access to your credit information. Some inquiries occur when you apply for credit. Others occur when you check your own report or receive pre-approved offers. In addition, reports may contain collection accounts and certain public record information. In the United States, most credit information is collected by 3 major credit bureaus: Equifax, Experian, and TransUnion. Each bureau maintains its own database. Because lenders do not always report information to every bureau, reports can sometimes differ slightly from one another. That means a person may have multiple versions of their credit report. Different reports, but the same financial story. Understanding your credit report is important because every credit score begins with the information found there. If the report is accurate, the score is more likely to be accurate as well. But what happens when the information is wrong? Many people assume that everything listed on a credit report is accurate. Unfortunately, that is not always true. Mistakes can occur. Information can be reported incorrectly. Accounts may appear with inaccurate balances. Loans may be listed incorrectly. And in some cases, fraudulent activity may appear on a report. Because credit scores depend on credit reports, errors can have real consequences. A mistake could lower a credit score, increase borrowing costs, or even lead to a denied application. This is one reason why reviewing credit reports regularly is so important. Credit reports can also provide early warning signs of identity theft. Perhaps an unfamiliar credit card appears, a loan application you never submitted, or an inquiry from a lender you do not recognize. These can be signals that someone is attempting to use your personal information. When suspicious activity is discovered, quick action matters. Consumers can dispute inaccurate information with the credit bureau. Supporting documentation may be requested. The bureau then investigates the claim. Federal law provides important protections during this process. Additional safeguards are also available. A fraud alert tells lenders to verify identity before approving new credit. A credit freeze goes even further. It restricts access to a credit report and makes it much more difficult for identity thieves to open new accounts. The best defense is awareness. The sooner an error or fraudulent account is discovered, the easier it is to correct the problem. Because protecting a credit score begins with protecting the information that creates it. Building strong credit is important, but maintaining strong credit requires attention. Fortunately, monitoring your credit is easier than many people realize. Federal law allows consumers to access their credit reports from the major credit bureaus. Reviewing these reports regularly helps ensure that the information being reported is accurate. A good strategy is to examine reports several times throughout the year. Look carefully at account balances, payment history, credit limits, and recent inquiries. If something appears unfamiliar, investigate it immediately. Many banks and credit card companies now provide free credit score updates as part of their services. There are also credit monitoring tools that notify users when important changes occur. For example, you might receive an alert when a new account is opened, when a hard inquiry appears, or when a significant change occurs in your credit profile. These alerts can provide valuable early warnings. Monitoring is not about obsessing over every small score change. In fact, minor fluctuations are normal. Credit scores rise and fall slightly over time. What matters most is the long-term trend. Are your financial habits moving in the right direction? Are balances decreasing? Are payments being made on time? Are there any errors that need attention? The goal is awareness, because problems discovered early are usually easier to solve. A few minutes spent reviewing credit information today can prevent major financial headaches tomorrow. And for many people, that simple habit becomes one of the most effective tools for protecting their financial future. A credit score is often viewed as a financial number, but in many ways, it is a reflection of financial habits. Every payment made on time, every balance managed responsibly, every smart borrowing decision, each contributes to a financial reputation that develops over time. The encouraging news is that strong credit is not reserved for the wealthy. It is not reserved for financial experts, and it is not built overnight. Strong credit is usually the result of simple behaviors repeated consistently. Pay bills on time. Keep credit utilization low. Avoid unnecessary debt. Monitor credit reports regularly. And protect personal information from fraud. Small actions may seem insignificant in the moment, but over months and years, they can produce remarkable results. A stronger credit score can mean lower borrowing costs, better loan opportunities, greater financial flexibility, and more choices throughout life. Most people experience financial setbacks at some point. What matters is developing responsible habits and staying committed to improvement. Credit scores are not permanent labels. They change as financial behavior changes, and that means every person has the ability to improve their financial profile over time. The most important lesson is simple. Treat your credit score as a valuable financial asset. Protect it, monitor it, and manage it wisely, because the decisions you make today may influence opportunities for many years to come. I'm Anders Buckley. Thank you for joining me. I hope you found this discussion informative and useful. See you next time.